Yeah, so just on FutureGen, it's interesting. There is a group that has just become substantial on both. It was FGX about 2 weeks ago and FGG today, called 1607 Capital. So if you Google them, 1607 Capital Partners, it's a US-based firm that's been around since the 80s or 90s, and they specialize in buying listed investment companies around the world. Sometimes they will go activist on them, sometimes they won't. So anyway, that's interesting. It looks as if, there's been quite a lot of buying in the screens on them. So no doubt it's probably them that's sort of been pushing up the price a bit, but that's certainly positive anyway.
Is that a long-term thing, or is that something that would give it a spike in the short term?
Look, I think that that they seem to, their approach is basically that they will identify quality listed investment companies and hold them for the long term. But then they would go activist if they needed to help resolve the discount. So I think that in an ideal, my guess is that they've looked at the long-term performance of the underlying net assets, and they've said these things are actually quite attractive structures, like we think. And in addition to that, they've seen the discounts that they're trading at. So they've obviously built a position. And then, if those discounts don't resolve themselves over time, then they'd
is that similar to the GB? It's a global value fund in a way, but they're probably a bit more in and out rather than hold.
Yeah, exactly. So it's a really good point. So GVF would tend to, they will be much more activist. So most of the positions that they will take, there will be some sort of a finite period that, to close up that discount. Whereas these guys are sort of, I think, they'll from what I see on the website, they would tend to kind of be happy just to own something for the long term as well. Sorry, Jay, you're just on mute there, Jay.
Can I say, Jay keeps muting me too, so I'll speak quickly. Is this likely to push the price up fairly quickly, do you think, Hamish?
I hope so. I think what you're seeing with these listed investment companies, generally, the whole market is cheap. They're all generally, most of these are trading at really big discounts to net assets. And so I think that you'll see those discounts close over the next 6-12 months across the board. Now, if these guys continue to buy aggressively, then hopefully that will be a catalyst. What you're also seeing, like with the conference call that you've got next week with the guys, basically speaking with Louise, that the underlying performance of the portfolios has started to improve a lot, and yet the share prices haven't. And so they're trying to get on the front foot to investors now to say, look, the underlying portfolios are doing what they should, but it's not reflected in the share price. This is a great buying opportunity. So hopefully all of those factors should help to improve those discounts.
Yeah.
Hey, Hamish, on a bit of a left turn off, I've sent you a couple of messages with some of the common requests, obviously topical, newsworthy stock that have obviously hit the headlines of recent time. The likes of, or not only of recent time, but have had a pretty solid run with the likes of Afterpay, A2 Milk. I think Xero was another one that we've had lots of questions about. Maybe it's just worth you touching on the history of some of those and why, although they appear to be fantastic businesses, their valuations aren't probably as attractive as as maybe their notoriety might encourage people to think it is when they're looking to invest. Maybe I know it's a fairly broad question, but give that a crack, mate.
Yeah, absolutely. Look, I think it's probably one of the most important dynamics in the market at the moment. There is, again, we're generalising here, but to really sort of generalise, there are growth stocks and there are value stocks. A growth stock is a business that is growing revenues quickly, whereas a value stock is something that may not be growing revenues, or its revenues might be going backwards. Now, obviously, you want to own the business that's growing, but typically that business that's growing its revenues will trade on a higher valuation. So the more difficult question with that growth company is what sort of price do you pay for that growth? And over the very long term, actually those value stocks tend to perform better because people tend to overpay for the growth stock and underpay for the value stock. And that cycles. So growth stocks will do well for a while, then value stocks will do well for a while. But what we've seen since the GFC, so, you know, the last 11 years or so, that growth has absolutely smashed value as a style to an extent that's never been seen before. And so within that are obviously the Afterpays, you know, I guess the WiseTechs, those sorts of things in Australia. And then globally as well, you know, there's a lot of these growth businesses that, you know, are just sort of skyrocketing. The problem with, whilst take Afterpay, it's a great business, and its revenues are growing strongly, but the valuation is astronomical. So, you know, the current market cap of Afterpay now is about $21 billion for a business that's not really generating much in the way of profits at the moment.
Is there basically no profit on a lot of those? They're essentially
that's exactly right. And just to put that 21 billion into context, so if we want to look at, you know, the largest companies in Australia, so say Woolworths is a $50 billion company, Coles is a $25 billion company, you know, Telstra is a $40 billion company, you know, ANZ, 50 billion, most of the banks are around that 50 sort of mark. And so all of those businesses obviously make huge profits and pay big dividends. Okay, their revenues aren't growing strongly, but so yeah, Afterpay as an example, if there's a perception that revenue growth slows, then you're paying $20 billion for a business that's not making a lot of money. And so you would think that, you know, that valuation. So now at the moment, Afterpay's, you know, it continues to exceed expectations in terms of that revenue growth. But things that can change that is obviously competition or regulation. That may or may not happen, but it's obviously not without risk.
Is it strange that some of the other competitors have grown quickly as well? I think it's ZipPay and some of those ones have, like, you know, quadrupled in value since the bottom of the market as well. Like it's just a crazy space that we probably just avoid. And I always look at it, if they can grow that quickly, that bubble can sort of burst just as quickly as well. But it keeps going.
That's exactly right. I'm just trying to, there was an email I think I had this morning that might be worth showing, but yeah, the thing with a growth business is you are paying a high price today on the basis of future earnings, as opposed to a more value orientated business where you're paying a reasonable price today based on those earnings today. And it's not that one is right and one is wrong. It's just that inherently, if you are buying that future earnings business, there's more unknowns, there's more things that can go wrong with that, as opposed to buying that business today that has those earnings today. There's more certainty with that. So now, you know, the whole technology dynamic, these are new businesses, they're less capital intensive. And so they, you know, they've had the ability to grow like we've never seen before. So yes, things are sort of different that's enabling this, but as well, you know, we do need to be careful. But, you know, like I think, as an example, you know, certainly for your SMSF clients, where we can buy direct international businesses, you know, there's businesses like Google, Visa, you know, Google as an example, like Google is growing its revenues at 20% per annum roughly. And you're paying, you know, probably about 18, 19 times earnings for that business. Visa is growing at about 20% per annum. You're paying probably about 30 times earnings for that business. So, you know, there are businesses that you can buy that, whilst the PE multiples aren't cheap, they're certainly not extreme like what you're seeing with something like an Afterpay.
Thanks, mate. I think it is important just to continue to provide that distinction to clients, that differential between growth and value, because, you know, the media cycle can be pretty influential in putting things up to people that maybe have a different context when you dig a little bit deeper. So yeah, thank you for that.
Yeah.
It's based a lot about where people are at in their life and what they're trying to achieve as well. Like, you know, younger people might be able to take on a bit more of those growth-based stocks rather than the value-based, if they don't need that income. But, you know, as our clients transition into different periods and stages of their life, then that weighting changes. And I think when you just pick up, you know, you might just get a subscription online, and plenty of people have done this over the years, and you read the first 10 that they recommend and go and buy them, and they're all growth based, and that these people might be at a point where they should be looking more at value, or vice versa. So it just doesn't apply to everyone. Just because one stock is good for one person doesn't mean it's good for someone else as well.
That's exactly right. I think you're absolutely spot on, Ben. And I also like to think, if you did have 20 or 40 billion dollars, like, would you go and and you only got to buy one company, like, would you use that 20 billion dollars to buy Afterpay that really isn't making any profits? It could be worth a lot more. It could be worth significantly less, you know. Now, in the context of a portfolio, if somebody's really has an interest in that business and everything, there's probably nothing wrong with having a very small position in it, but they need to be aware of the potential downside risks of that as well.
Yeah, definitely.
We've got about 10 minutes left, Hamish. Can we just take another bit of a diversion to what happened in the last couple of days with the government stepping in with a little more stimulus, which seems to have the market seems to have liked. What's your take on that in terms of the continued government stimulus, and whether or not how positive, negative, or otherwise that is to the market? Obviously, it's reacted pretty positively yesterday, but short to medium term, what's the view?
Yeah, look, I think it's definitely a positive as far as the market's concerned, you know, because you're seeing there's a number of businesses, and we're really going to get a feel for this over the next month or so as all these businesses are reporting their full year results. But a number of these businesses have benefited significantly from, you know, the JobKeeper type stimulus. So the market, a lot of commentary has been, well, the market's gone up so much, and we're facing this cliff in September when all of this stimulus rolls off. So what happens then? Which is a legitimate concern. But obviously the government, by extending these measures, is addressing a lot of that concern to a certain extent. So, you know, I think that's why you saw that relief rally yesterday, or the rally continue yesterday. So that kind of keeps businesses on life support again for a little while longer, until hopefully there is some sort of a recovery out the other side. So it is this battle going on at the moment. You know, markets have sort of, without question, have been propped up by the stimulus that's out there and that has now been extended. In terms of how sustainable that is, it depends on what the economic recovery ultimately looks like. But certainly, you know, this is a positive thing. And I guess it demonstrates that the government is going to continue to sort of do whatever it takes to try and get the economy through the pandemic.
I suppose on top of that part, and probably what people see a lot on the news that's a bit more negative, so it gets more coverage, is the US and being, you know, a bit of a shit show. So, like, how does that, you know, you look at how our government's doing it, it's probably quite staged and sort of conservative, propping people up, versus the US where it's sort of completely different. And obviously we're not in the US, but it impacts us a lot. How does that sort of lingering uncertainty keep hurting our market?
Yeah, I think it's crazy what's going on over there, right? You know, I mean, I think I'm not sure if this is addressing the question, but you know, as far as the virus is concerned over there, they're not in nearly as good a shape as what we are. Now, I think that if you listen to a lot of these experts at the moment, they all seem pretty convinced that we're going to get some sort of a vaccine. And then the question is the efficacy of that vaccine. And I think that the way that the markets are behaving, it's pricing that outcome in, because obviously if, you know, the lockdowns that we're currently experiencing are going on for the next 5 years, then, you know, markets are too overcooked. So I think that, you know, there is an expectation. So I guess to your question, regardless of how crazy the situation is over there, I think that the market's trying to look through all of this and say, well, if we get a vaccine and if life goes back to normal, and we've got these sort of life support stimulus measures by the governments to get us through, and then ultimately you have the economic recovery out the other side, you know, the market's trying to sort of look forward to that.
So essentially the market is trusting the scientists that at a point, you know, not in 10 years, that they're going to be able to find a solution in a way. So I hadn't really thought that's interesting.
Yeah.
Hey, Hamish, have you listened to Peter Schiff at all?
To what, sorry?
Peter Schiff.
Peter Schiff, no.
He's an economist. He's notable for, you know, having predicted 2008. I sent it to the guys during the week. He's talking about his view on the government debt situation in the US, and as sort of a true sort of free market capitalist, his view was that interest rates, the Fed should be rising interest rates, the government should not be. It's a fairly hardcore, but rates should be rising. The government stimulus should be less, and businesses that were teetering on life support anyway should just be left to natural selection to live or die. It was an interesting. The podcast I sent through to the guys was pretty interesting. It's obviously fairly probably extreme view, but he's been sort of talking of this for a long time, but just the unsustainability. And that's one of the things that I look at as well, that you look at the American government debt. I know we talked about debt, consumer debt, another time on one of our calls, but this idea of at what point of kicking the can down the road with government debt in the US, at what point do the inflationary pressures just become such that the US dollar is just not what people have seen it to be in the past? I know that, who knows? It's a who knows, but that's the one that I think is you look at it and say, well, when you've got, what are we up to, about $27 trillion, maybe $23 trillion worth of debt, they've just spent about 3 trillion, probably haven't proportioned that great by the looks of it. Where does that and how soon?
They're massive topics, and they're really difficult, complex questions. But and I guess I would say
I just want a one statement answer, mate. I'm not asking.
Exactly.
And we will hold you to it as well.
So how I think about this is the more macro you go, the more difficult it is to try and forecast what will actually happen. I think if you look at one particular company, you've got a better chance of understanding all of the drivers, and then the more high level you go, the more difficult that becomes. And I think there are so many sort of experts that are out there trying to forecast, what the macro economy looks like, and as you would all know as well as I, that they have just as much chance of being right and wrong. And I mean, with what you're seeing with the way these central banks, about how monetary policy has evolved and everything, nobody would have imagined that we would be in this position today, but things kind of just have a way of, I mean, if you had said 30 years ago that government debt was going to be as high as it's going to be, you would have, the natural thought would have been that interest rates would explode, because there would be a concern that governments aren't going to be able to pay back those debts. And yet interest rates are at record lows. It's just so hard to forecast. But yes, I think that if ever there was a chance of inflation coming, you would think that it's now with what's going on. So we've been in this period for some time now where there's been very little inflation, there's been very lackluster growth, and it's just kind of been this grind our way through. And maybe the fire is finally being lit now with all of this stimulus that's being thrown at it and everything, that maybe you do start to see that inflation come. But I don't think you can predict that. I think all you can do is be aware of the potential risks out there. And if you do start to see things change, then you've probably got to try and adapt accordingly. But I think it's difficult trying to forecast that.
Hamish, with that, like a couple of the points you've just made then, you sort of talk about the macro, micro side of things, but also that capacity to look forward and say, well, there's significant risks ahead of us, but we really don't know how big they might be and when they might come. So if we take that back to sort of a day-to-day buying shares on the share market concept, then we need to be in the share market, because at this moment in time, it's going to give us reasonable growth, and it's the best place to get income for our clients, for all of us.
Yeah.
So do we then have to come back to the fact that we have anticipation, or it's about the preparing for the crisis without knowing when it's going to come. So we know it's likely to come. So if we're going to go back to the micro, let's make sure that we do purchase things that will hold up better than other things in times of crisis. We'll come through it with strength because they're not carrying massive debt, or they're not, structurally inefficient businesses. And some of the conversations earlier today, like, do you go and buy an Afterpay that's already gone nuts? And if something goes to shit, well, all of a sudden it just goes massively the other way, as Ben said. So again, building in the fact that we anticipate, we expect and are prepared for a future crisis, but we ain't going to not do what we do now for fear it will come, because we don't know when it will come. So we've got to be a bit more, really selective and clever about what we buy now, understanding that somewhere down the track there'll be another shitty situation happen.
And
that's it.
Yeah, sorry, I was just going to say, and also on that micro level, PB, for the clients listening, it is at that micro level, that preparedness for crisis is making sure that the portfolio is constructed with sufficient defensive assets to be able to support it, like we've seen in sort of February, March, those clients that had a relative cushion and a protective insulation of defensive and cash assets have not only weren't impacted as badly, but also had the opportunity to then take advantage of some of the opportunities that existed from sort of February onwards.
I think that's been it's been a little bit of a battle in some senses over the last few years to justify having that significant income cash exposure to assets that are producing basically nothing really, like term deposit rates and bond rates and things are so low. But this is a good example of why you have those reserves there, and you know, generating neutral at the moment is quite okay. It just gives you buffer and gives you opportunity. So just reinforces that.
That's exactly how I think about this. Is there is always uncertainty, and it feels like there is more uncertainty than usual at the moment, clearly. But I think all you can do in this environment is own a diversified portfolio of assets. So shares have to be part of the equation, because if in this low interest rate environment, you know, shares could, you know, be sort of the only game in town, but things could go still very wrong for the share market as well. So shares cannot be the only part of the equation. You've got to have your cash and your fixed income, you know, and property also fits within that. So, and I think that if you have a decent spread of all of that, you don't need to worry about too much about what's going on from a macro perspective, because whatever happens, you'll be okay.
That's a nice way to finish, Hamish. Well wrapped up. Thanks again. We better jump onto our next meeting. But mate, thanks again. I hope you had a good break. And I think I might have missed you and Peter waffling on about holidays before we jumped on.
How beautiful Noosa was.
Yeah.
We better not make people jealous.
So maybe in a few years we'll be able to visit again.
All right. Thanks heaps, Hamish.
All right. Thanks, guys.
See you later,
Jump out of
everyone.
the car,
Good to chat.
race inside and hook up on the laptop to join our next meeting. See you soon, guys. Thanks, Hamish.
Okay.
Cheers for that.
Thanks.